Good afternoon and welcome to Chicago Future of Finance. I'm Oliver Rennick. This is episode 15 and live here from SIBO on the floor. A pretty calm day. Market's pretty firm as we go into a pretty important couple sessions of economic data that are coming on the way. That's definitely a focus of the conversation today. We're talking generally a market that's been in really good shape. Nvidia's breaking out. Bitcoin's making a big move again. It looks like risk on. Bonds, which had started to kind of go both ways, firmed back up, and generally the market's been pretty amenable to a rally. Right now, you've got the S&P 500 at 67.17, so a 40 basis point move, and we're looking at all-time highs. This is a market that just continues to find its step no matter what is thrown its way. Though admittedly, not a ton has been thrown our way from a negative standpoint. We had a decent little surprise, a slight beat on manufacturing ISM. Services is going to be very important, and the employment situation, of course, on Friday is huge. But overall, tech has continued to lead the way, and that's what I mean about us not having a lot of curveballs thrown lately. This is still a pretty straightforward story. It's about innovation. It's about the power of capital markets to feed and fuel that innovation. And what I believe now is a continued strong run post-COVID that began in the depths of that crisis as we printed money, we juiced up the economy, we continue to promise and make sure folks know that the government basically will always have our back. And thus we are cutting interest rates again. Since then, that input of monetary force created the output of incredible technology. And now with companies like NVIDIA leading the way, we fall back on AI as an incredible tool for small business owners, for entrepreneurs. It's powerful stuff. So market continues to grind and NVIDIA is out in front. I think it's going to be interesting to see what the dollar does over the next couple sessions. The greenback generally has been range bound and drifting back negative again after a bit of a jump following the Fed cut. I think is something to watch as well. Let's go through the rundown here of who's joining me this afternoon because we do have a good show coming up. Hans Albrecht is going to join me from the top, thinking about volatility. Again, VIX pretty calm. We're going to have Pete Najarian on joining me to talk about some of the event contracts we're seeing from Kalshi, betting on the economic outcomes over the next couple days. We'll see what else is in Pete's hopper and what he's trading or betting on right now. Then we're going to talk about one of the biggest success stories in Chicago ETF land. That's Calamos Investments Auto Callable Fund, which is over $250 million right now. If you pay close attention in the promos to this show, the buildings are not chosen by chance. Calamos is one of those buildings featured in the promotional video for this show because of the rise of some of their highly successful funds. Yesterday, we talked about Innovator ETF's double-sided buffer fund, which is a very interesting asymmetric payout. So the theme of products that are designed to limit downside but find different tweaks on that strategy continues to be a big theme here of the show this week and generally in Chicago too. I'm excited to catch up with Jimmy Lee, Wealth Consulting Group, one of the sponsors of this program, but he hasn't been on the show yet. 15 episodes in, we're going to catch up with him and what he sees on the advisor trends coming back from Future Proof Conference in California, which was going on while we were at Hood Summit in Vegas and then RMC Munich. So Jimmy and I are going to talk a little bit about how this kind of calendar, this season of conferences has informed us from our different perspectives, from options and from advisors, where a lot of that stuff is coming together. Then Scott joins me for a look at the risk radar. Nothing's changed on my risk radar. It's generally been green for risk assets, yellow for some of the macros. Maybe we'll get answers to that. So I definitely want to get Scott's thoughts on how the next couple of days of economic data have potential to affect us. Right now, let's talk some volatility. Let's bring in Hans Albrecht joining us from Gamma Capital Advisors. A guy definitely who has a lot of experience running funds and running options strategies as well, collecting income. Hans, we spoke back in the day on my show at your previous shop where you were, we talked funds and, you know, I think the combination now of what we're seeing in the options market and then a lot of the ETFs that are using options, it kind of feels like a lot of the worlds that you've been involved in are, you know, coming together at here. And I'm sure you see it similarly to how I have here from the floor.
Hey, Oliver, thanks for having me. Absolutely. I mean, look, from when I started doing this about 15 years ago, I started running those income funds. This market has absolutely exploded. And as we know, we have the single version of the covered call funds, and they've really sort of captured the attention of so many people with this idea that you can kind of generate income while you sleep on the weekends on your favorite stocks. And it's amazing. And the way that sort of worked its way into the volatility landscape has been very interesting, because as we know, these funds, and I'm to blame for this too, when I ran these funds, you're compressing that vol. And so that upside tends to be compressed because it's very supply driven, right? The call side of the skew curve. And we know the downside is sort of demand driven. And so we've really kind of created these environments where that upside becomes very, very interesting. And so as we've watched this incredible rally, I've been screaming for a melt up for about 1,000 points now. We've seen that upside get remain very, very cheap until fairly recently. We're starting to see that upside really kick up. And that's very interesting.
That's price for calls. You're talking about the options premium you're paying for calls, because generally they've been pretty cheap despite the steady grind, right? That's something Brent Kochuba and I have talked about as well. I think it's an important truth of this market to understand. But you're saying maybe it's starting to change a little?
100%. So it's been not just the overall level of implied volatility, which is what you're talking about, but also that upside call skew. So when I start to see that call skew, as we vol traders sort of look at all the tea leaves, and when you start to see the call skew start to pick up a little bit, that can be a sign of excitement. That can be positive. What you want to look for is a sign of exuberance, of kind of eventually exhaustion, really, which is when that upside call skew just gets sort of too FOMO-ish.
So we're not even close to that yet, right?
Yeah.
So we're not even close to that yet, is your point, where maybe it's starting to show a little bit of that energy, but still generally pretty calm, nothing that looks like it's exuberant or manic.
It's not too crazy now. It's hard to get super bullish. I mean, I'm massively bullish overall, but in the short term, I mean, it's as you talked about earlier, it's very difficult for the bears at this point. There's really nothing to hang your hat on. There's really nothing apart from technicals and just having gone too far.
Who cares?
Yeah.
It's part of our system at this point. So I hear a lot of people talk to like geopolitical risks or governmental risks, and I don't know, Hans, to me that's just like the number one building block in the wall of worry generally.
Well, I mean, if you look at sentiment, we've never quite seen a market like this where you see a number of measures of sentiment that are actually very, very low. There's a certain segment of the population that is quite dejected and not very happy about things. But the market is telling you that something good is happening. And the fact is GDP is strong, retail sales are good. There are a lot of very, very positive things. All this worry of recession and stagflation, it's just not happening. And there's very, very little evidence to show that that's happening. Now, if you back out AI from the economy, now you start to see where some of that worry comes from. But we are having a bifurcation of market and Main Street that we've perhaps never seen before.
Hans, how important is it that a key part of the strength of this economy has been household ownership of equities, which is at an all-time high, individual investors who have been successful in their portfolios? I mean, this is what we're talking about with Robinhood at all-time highs. Options-driven strategies. I know people who literally have quit their job. Earlier this week, I had a call with somebody who runs a $60 million portfolio, and he just learned options, in the past decade from watching Tom Sosnoff on Tasty Trade. I mean, how important is the fact that people can invest in these tech companies, that we can basically live off capital markets, even if these AI are displacing some jobs? Is there a connection there that we should be making?
I think there is, and I have been talking about this a little bit, how you're probably going to see, as we start to see the job picture unfold, you may get people more interested. Now, I covered this way back, Oliver. We've known each other for a while. I covered this way back, the whole Industry 4.0 and all that. And I remember even years ago saying, listen, if you can't beat them, join them. That means just if these things are coming for our livelihoods, I don't want to be negative here, but there's quite a bit of disruption out there in the job market. I mean, you might as well
join them. You might as well invest in them, right? Exactly. If you can't beat them, invest in them.
Yeah. I mean, look, you almost have no choice. It's your hedge, right? In a sense, you're hedging out this eventuality that is unfortunately coming. I think it's a little bit more collaborative. I think AI is a little bit more collaborative. But if you look, there was a chart I saw the other day showing productivity really starting to take off with jobs just being very, as we know, there's no hiring. So this is very real, and it's actually early innings. And this inference stage of how this starts to play out throughout economies, extremely early. We are not first inning. We are on our way to the ball game. And so we're going to start to see some big things to potentially worry about over time. But in the meantime, I think the market's going to love it. And I'm actually quite positive overall, because it's about profit margins. You talked about Like if you look at who are the spenders, it's the retirees, the people with assets. You talked about home ownership. If we start to see rates come down a little bit, you start to unlock some of that equity. So without question, this has not been a fair environment for this certain segment of the population that has suffered from inflation, that does not own a home, that does not own many stocks. This has been an asset holder's dream, and they are the ones driving the bus right now.
You reward the ones who are, invested into it. So there's kind of a, look, that's how capital markets are. They can be brutal. Exactly. They will leave people behind. They're designed to. Hans, so speaking of which, maybe a good time to bring up AI, as it is collaborative indeed, helps me without a co-host. I asked the AI that we've been using if there's something near term that's a threat to the U.S. stock market or a potential source of volatility. It says everyone points to jobs reports or CPI, but those have already been heavily hedged and priced in. The real blind spot is the gap between calm equities and stressed credit and treasury markets. Bond volatility is high, credit liquidity is thin, but equity options are still cheap. So if hedging flows are forced or a credit hiccup happens, then the S&P could gap violently. I like its point about the big data releases not really being a big factor for volatility necessarily, but I'm not sure about the credit situation. It doesn't seem like there's too much volatility there. I mean, bonds continue to kind of firm up. What do you think?
Yeah, and that's where you have to dig a little deeper for those signs of stress. Now, the good news from an equity standpoint is that equities are a little bit slow. They're a little bit like, what's going on? So we start to see some of those warning signs early in other asset classes and other areas. So we definitely want to watch for those. In the equity world, what I look at some simple things like, where's realized volatility? Okay, it's down in the 7s, it's in the 6s, 7s.
Right.
When you see
that part,
gap,
the AI gets right. The volatility price for equities is definitely low. I think the AI got that part right.
And that's where you start to worry. When I start to see a gap between the VIX and actual short-term actual volatility, it's the market telling you that something is a little bit out of balance there. And so from a short-term perspective, I'm a little bit worried at this point. We could be not far, as bullish as I am, we could be not far from 30% sell-offs in some of these AI names that have really had a wonderful time.
Hey, well, Nvidia just broke out. Hans, okay, so then you got any specific trade for me? You got something that's on right now we can keep track of, we can watch?
Well, I've moved into a little bit more value. So out of things like AVGO that are trading well above their 10-year averages in terms of valuations, and into things like Micron, which is more U.S. focused, more memory focused, which I think people are underestimating. You look at things like—
Nice rip in Micron today. Huge.
Beautiful. A beautiful move today. And even some of the I think Mag 7, well, guess what's doing well? Suddenly Tesla's doing well. I think they are one of the great moonshot stocks out there. It's for a specific part of your portfolio. You do not want to get crazy on something like this, but think about— no one even talks about their power generation. It's robotics, it's cars, who cares? It is about power generation. These guys are sitting there, they've one scale. It is a one-man show, so there's always the risk that you've got one man running it. But I think that's a very interesting—
It can also be the one man you want to run it. People love Elon.
It is.
Here's the chart for Tesla at 460 right now. I mean, it's a pretty nice looking move. Pulling up Micron also, that rip there to 180. That's a pretty darn good looking chart. And you don't think this is a one-off move here?
I don't think so. I think option pricing is actually a little bit interesting there, compelling there. Whereas in some other names, I'm seeing a little bit of exuberance, a little bit of excitement. In Micron, I think this is a name that could get up into the 220, 230s rather easily, because they're in an area, that memory area, which people have been underestimating. Look at those Western Digitals. Look at those Seagates. This is an area where it's like a backpack you got to put on your GPU. There are no GPUs working properly without memory. So I like it very much.
Okay, nice. Love it. Micron, watch. Tesla chart 2 picking up. Nvidia ripping as well. So,
Google,
I mean, you don't want to really get in front of that freight train.
I don't think so. You mentioned
what the bearish
Nvidia
take is when these stocks are breaking out.
No, I don't think you want to get in the way. I don't think you want to be bearish. I think that's how this market's going to go. And I actually think that there's going to be a bit of broadening happening, because if you look at profit margins, they're starting to curl up a little bit in the small and mid area. And think of what the internet is going to do. What did it do in the 90s? It set us up for decades of the internet. What the big cap hyperscalers have done is they've set the foundation for an inference move into the broader economy. So I'm actually getting quite constructive on other parts of the economy that can now benefit from all the fun that these guys have had.
Yeah, love that. Nice, good. Good value take. Appreciate it. Hans, good to catch up. Good to have you on the show.
Thanks, Oliver.
All right, let's talk some more economic data. Let's do some trading. It's time for the gamble. Yo, Pete Najarian, how you doing, sir?
I'm doing really good, man. I tell you what, I love listening to Hans just now. You know what? I feel like he and I are on the same page on a lot of things. Maybe one or two, right? But yeah, same page on most everything. It was great.
The tech stuff breaking out. You like the idea of riding the big giants again?
100%. Yeah, I have no hesitation on that whatsoever. Yeah, I mean, I think we're still at the early stages, even though everybody keeps saying, well, you know, this AI thing. Sure, there's going to be some bumps along the way, but I still think that there is plenty of room still to the upside, Oliver, and the options are telling us that. From the options that we are seeing getting traded day in and day out, where are they targeting? You know, who's getting the most call buying and that type of thing, and we're seeing that out of some of the biggest names, and it's amazing how far out into the future in terms of what they're looking at for these stocks to maybe double or triple. I mean, it can be pretty incredible. Now, I'm not saying that's going to happen, but that's what the indications are from some of the options that we're seeing trade.
No, I think it's fascinating to see that type of fervor come back in. Think about the round trip, basically, that Tesla's had as an example for what Hans brought up. You know, to go all the way from near 500 down to 210 and the low 200s to be back at 460. It just feels like things that go in that U-turn probably keep going. You know, what are the like what Tesla's going to double top, or nothing's changed from the bull case that people are making from that for that stock or any of the others. Frankly, I feel like, Pete, especially because you just see a lot of things around you making a difference. You know, like Siebel's going to do their show in Nashville. The RMC is the next conference, and literally the day I was looking at it, Waymo announced that they're going to be doing self-driving cars there. You know, this stuff just keeps showing up everywhere.
Yeah, and I'll tell you, just to that specific name, Tesla, even just today, seeing some unbelievable call buying that we're seeing in there. The stock was trading about 460. They're going out there out to March. They're buying the 870 calls against the 880 calls. So they're buying spreads way up above where we are right now. Pretty good size, talking about 18,000 options trading there. So is the run up over? I don't necessarily think so, because on what I'm reading through the options that we're seeing trade in some of these very, very large trades, a lot of it still looks pretty bullish, and they're smart. They're putting on spreads, so they're buying, some higher volatility names specifically, but they're selling some of that volatility by spreading off from in this particular case, buying the 870s, selling the 880s. So a $10 spread. They're not as much, out there to lose that way. They're actually giving themselves a little bit of room.
Nice. Okay. So that I think makes sense, especially in some of the stocks where there is a little bit of that interest in call buying, that kind of skew that doesn't exist in the broader market, like Hans was talking about. It seems like finding stocks that maybe do have that opens up different ways to trade them, right? Whereas the market's just kind of generally a flat kind of vol right now.
Right. Well, I think the smart thing about the market, though, that you guys probably have talked about this a lot already today, but what I've been watching is this rotation. And Oliver, it's been absolutely incredible, because one day we're led by energy. The next day it could be the financials. The next day it could be technology. It could be materials. It could be metals. It could be whatever. And I think that's an important part of what I view as a pretty healthy market. To see that kind of movement that we're seeing, it's not just technology names, it's other names outside of that as well. Now, certainly there are some great moves out of some of these tech names, some of the semiconductor names and so forth. We talked about, you guys were just talking about Micron. I used to be the specialist on the CBOE floor for Micron. Great trader back then, still a great trade now. I still see a lot of semiconductors out there that are showing us who's really sort of moving to the upside now in a big way. And I think some of those names are absolutely explosive to the upside because of the demands for what they build.
I love that move today in Micron's massive. I think a lot of people suspected this was going to kick in, and it finally is, because it did have, a pretty, sluggish kind of start to the year. So the catch-up move is violent. People don't want to get left behind. The other one too, Pete, obviously we've spent some good time talking about, is GLD. Amid all of it, still finding buyers too in this category is pretty impressive as well.
Yeah, and the volumes that we're seeing, I mean, just the sheer volume that we could start with that. when you look at September and you look at a month where we had the largest that I've ever seen, I think we averaged close to 65 million contracts per day when it was all said and done in September. That's unbelievable to me. And it's something that we've just been seeing it time after time after time. And when we're seeing some of these huge trades, GLD is one of them. They have not gotten tired of buying upside calls in GLD, even though we've made this move from 3,500 to 3,900 in a pretty quick move when you look at what's happened with gold itself. But this ETF with GLD, they just coming after it. They just continue to come after it and come after it. And it's not just gold. We're seeing it out of silver as well. That's why I keep joking with you and others about this being the Burl Ives trade. You know, it's silver and gold, and they're absolutely
man, look at SLV. Yeah, $43. I kind of missed that move while I was abroad. I was so focused on the currency, the fiat exchange rate. When I was traveling, Pete, I forgot to watch the hard metals. Wow, the move in silver finally came, did it? Wow, I didn't even realize. I got to be honest, that's incredible.
Yep. They're coming for that, and they're coming for the SLVs as their surrogate, their ETF for silver. And we're seeing more and more of that all the time. So it's been incredible. They've been indicating to us by what we're seeing in the options world that they're still expecting upside, despite the fact that it's made this incredible move to the upside already. I mean, when you're talking about the kind of percentages that you're moving out of GLD's up 50%. That's pretty big, I would say. 63% silver. So are they taking off like as if they are an AI stock? Yeah, to some degree they kind of are.
That's actually a pretty interesting point, Pete, you just kind of awakened the materials scientist in me. That's kind of always been the story for SLV, is that its differentiator from gold is its more utility and industrial use cases. So maybe, there might be something there, right? I think that's very real.
Yeah, and I think a lot of people do look past that. They don't realize the fact that gold, for the most part, is just gold, right? And that's a safe haven that sometimes people go to, and obviously been seeing more and more of that. But with silver, you've got the fact that, of course, it's that metal, but what are all the uses for silver? And a lot of that in the semiconductor world and other places. So certainly far more of a utility for what we have in this world that we live in, as opposed to gold. And it's made an incredible run. And most recently, it's just started to accelerate, it feels like, to the upside.
SMH chart 332 looking pretty darn good overall, just breakouts across the board. Pete, while I got you, let's go into Kalshi and let's talk about some of the economic stuff as well as the governmental stuff. Your brother yesterday, we talked about the odds of shutdown. That went from 86% to 100%. So that trade did decent yesterday for anyone who was doubting that there was going to be a shutdown. Now the question is how long it lasts. Kalshi says only a 44% chance of more than 10 days. 76% chance of more than 5 days, though. So this could linger for a bit.
I could see some lingering. I think that one's pretty accurate, the 5 day. I think there's going to be back and forth. Nobody ever wants to give in, and that's a good and a bad thing, right? I mean, it's a bad thing because there's got to be some sort of negotiations, because at some point it's going to have to happen. Will they do it in the first 5 days? And as we're looking at this with Kalshi, and you know what? It sounds like that there is some possibilities out there. It's interesting. I don't know that I think it goes over 5.
Okay.
I hope I'm wrong. I really do. I hope I'm wrong on that, but I think it goes over 5.
Wow. All right. So then you're making $24 on 76 right now. Not bad. If you're thinking it goes longer than 5 days, that's not a bad trade. The other thing too is that these are short-term trades as well. Obviously, that's kind of the beauty of some of these event contract stuff. It's like the zero DTE version of options here. People are taking 31% on more than 15 days, though. That feels like a pretty sizable bet there. I mean, that's not nothing. That's not insignificant.
Right. I mean, that's like going out there and looking at the Dallas Cowboys playing against the Raiders and trying to figure out, all right, well, what's going to happen in this? It's really interesting to me. I mean, 31%, though, that is incredible. I don't think it goes that long. I'm not saying that it won't, but my gut tells me it's going to be more than 5, under 15, and I'd actually maybe look towards that middle ground and say, hey, it could be over 10 days, but I don't think it goes 15.
All right. Nice. Love it. Fun. Good diversity in trading of instruments and asset classes. Thanks a lot, Pete.
Always great to be with you, man. Have a great day.
Appreciate it. Likewise, sir. Pete Najarian, Market Rebellion. Okay, coming up. Let's talk some more ETFs and continuing a theme that has been prevalent here this week and in Chicago, which is protecting the downside. We're going to talk with the portfolio manager of $250 million Calamos auto callable fund. Matt Kaufman joins me next. There are two things about Chicago finance you can't get anywhere else. The first is kind of hard to miss. Everyone's trading options. SIBO is on a 5-year growth streak making billions, and its goddess of grain sits atop the final pit of open outcry. And that's what it's all about. The chance to fend for yourself. A fortress for the self-made trader, and the only still standing in America. The second thing you may not know, but it's worth trillions. Chicago is the only major city in America that's home to 2 of the top 10 registered investment advisors, according to Barron's. That means a steady river of passive money and fixed income pouring into the city. If you think you can beat the market, this is where you do it. If you've got value, price will discover you here in Chicago, the future of finance. Join me, Oliver Rennick, from SIBO, Tuesday, Wednesday, Thursday, into the closing bell, live from Chicago. Welcome back to Chicago, Future of Finance. Let's talk ETFs, and in some sense, the local news version of our show, as I was just joking with Matt Kaufman, head of ETFs at Calamos Investments, joining me here on set at SIBO. We were talking that the keen Chicago observer of architecture in that promo would notice the Calamos office over on the west side of Chicago in one of those shots. And
you got the Calamos building in the West Loop. It's nice to walk down the street to come here. You don't have to fly to New York. We're all right here.
That's what is great about Chicago Future Finance, is that I really do believe that, especially after being abroad the last couple of weeks. I was talking yesterday, I believe it even more now. But so much of what is kind of the nucleus of finance is here in Chicago.
For sure.
Your guys' growth in one of your funds, the auto callables, over, it says on the screen 250, but it's now at like 280, which means you must have been pulling in money literally from the time I checked that a couple weeks ago.
It's been tough to keep up with the flows. Obviously, we're thrilled with that adoption. The auto callable space is a massive segment of the structured note market. If you're familiar with covered call funds, that's a $150 billion market in the ETF world. But you go to structured notes and auto calls dominate derivative income there. So we built the world's first ETF that brought that into the ETF world. Auto callables, it's a lot like a long dated put writing strategy that has a call feature. It allows you to get a really high stable income with getting your principal back, at the end of the outcome period or the end of that life.
Okay.
You can think of an auto call a lot like a bond that pays you monthly income and then returns your principal as long as the equity markets don't fall too far. So you're tied to equity markets instead of duration or credit. But that fund has taken off, 280 million in the door. The volume is going very strong. A lot of demand for that.
It is so thematic. This fund, yesterday, Innovator ETFs was here with the twist on the buffer concept.
Oh, sure. Dual directional, I think.
Exactly.
Right?
Yeah,
exactly.
Very interesting. Almost like a way for someone to actually get rewarded if the market goes down.
That's
their
right.
highest payout
That's right.
when it's actually down. But so much of these are focused on either kind of hedging downside or having a guarantee.
Yeah.
But then I can't shake this irony that the market just keeps going up.
Right.
So where do you think the spirit of it is stemming from? Is it just preservation of capital?
I think so. Yeah, this doesn't need the market to continue to go up to work. This is just for clarity. This is not a defined outcome fund. We're not delivering a certain result over an outcome period. We've laddered together 52 or more auto callables. We've done that synthetically. We've partnered with JP Morgan, taken their pricing model, delivered that into an index that we've built with Mercube, and then we trade that index on swap with JP Morgan. So really strong collaboration with those two institutions, and we've delivered that into the market, a derivative income type strategy. But yeah, not a defined outcome fund, but certainly gives you really high stable income there.
Where does the auto callable market originate from? You mentioned the structured product category. Halo Investing here too, a big player in that.
Yeah.
So much of the Chicago again to
That's
kind of
right.
keep bringing it back home.
That's right.
But conceptually and kind of makes sense. Mechanically, where does it start from, and what's the liquidity of those auto callables, and is that market getting bigger? Who's servicing that?
Yeah, good question. The auto call market takes about 50 to 60% of the volume of structured products in the United States. It's about similar around the world. It's a massive market globally, and people love the auto call for the ability to collect a coupon as long as the underlying index doesn't fall too far. So when you build an ETF, you want to build something that's on a really liquid underlying. So we've used an S&P 500 base that has a volatility target to it, and that really stabilizes the options pricing. So we're in the options pit here. We have stabilized parameters of that pricing model so that we can deliver a really high stable coupon every week that an auto call gets issued into the product.
Okay, so you're guaranteeing basically 100% par all the way down to a pretty deep sell-off level. What,
60% is a 60% principal barrier or 40% minus performance barrier.
Okay.
That's correct. Yes.
And then 14%, if we actually take my screen, I'm pulling it up right now and make sure I get all the numbers right. The dash line here is when you add in the coupon, which gets you to what, 114?
That's right. Yeah, so you can think of those dashed lines as your monthly coupons. The dark blue line is your principal value. So as long as the reference index doesn't fall by 40%, you're going to get your coupon.
That's that par level payout all the way down to a big drop in the market.
Exactly. So then if the market is down by 40% at maturity, so these are 5-year auto calls, so that line's got to be down by 40% 5 years from now for you to start losing principal. So you can question like how often does that happen? The only time you would have knocked in on this strategy would have been during the global financial crisis. And you would have lost about 17% of principal. That's the risk you take on. But since then, you would have gotten every single coupon. You would have gotten all of your principal back at maturity or when you're called away. That's in the name, the auto call feature.
Got it. Okay. I feel like a lot of these funds, they're kind of, they're providing a purpose, a service to functions that you could kind of do if you were very active in the market, basically.
Sure.
Or even if it's, like I think about people who are buying CDs and moving from one to the next, there's, it's a very different type of, I think, approach or purpose than some of the other kind of either defined outcome. I know you don't define it that way, but
for sure.
Buffer concepts as well. what I also want to bring up is the notion of kind of how the premium shifts, because anytime you're talking about options, we want to think about, okay, well, is this because of a volatility regime that you're kind of assuming is going to hold, or how much does that guaranteed premium sway based on what happens in the market?
Yeah, that is one of the beautiful things about CAIE, is that vol premium, that income you collect, is largely stable. It's about 10 to 11% over risk-free rate every week. So you can see, we have a tool on our website where you can see we've laddered all of these auto calls together. That laddering concept's, not new. People ladder bonds, they ladder different types of strategies. We've laddered together auto calls. What we're seeing from advisors is that this is the easy button for them. They said, we usually shop for auto calls all the time. We get called away. We have to go buy a new one.
Right. That's kind of talking about the mechanical process,
exactly,
right? The actual physical. You're kind of doing that service, basically.
Yeah, so they called when we launched Kai, and they said, we love this. You've solved a massive problem for me. One advisor in particular said, I fly to New York every quarter to meet with the banks, find the best notes. He said, I'm not flying to New York anymore. This solved that problem for me, which is great.
That's a good sales pitch.
Yeah,
right?
exactly.
Save up, but then you also don't accrue the miles as well. So
true. There's a trade-off.
Come back to this real quick, because I think this is kind of cool that you guys are putting this out basically data actively, right? So you can kind of see where the premium's at based on maturity.
That's right. So this is a dashboard, an auto call dashboard. Looking at your screen here, you can see that we've laddered together 52 or more auto calls.
Okay.
Each dot is an auto callable
contract. Okay.
You can see the term sheet for every one, and as you hover over, you can see that stable income, about 10 to 11% over risk-free.
Got it.
So, you look at covered call strategies. When you sell that option, volatility is a big driver of the income you can collect. Whereas here, when you sell that put option, the premium income is largely stable because we've stabilized the volatility.
Very interesting. And I love that you can actually hover over and see it helps you understand what's happening here.
For sure.
When you think about it as kind of the weighted average. There it is, the weighted average coupon, bottom left. Bingo. That's how I know I'm following along.
There you go.
Because, you see some of these up here that are really juicy, right? Like there's one here at Fort. So that's cool. I like it.
Yeah.
I asked our AI, who is kind of interested in this type of fund. You kind of already hinted at this, but I said, what kind of investor? I want to hear your reaction. It's less about conservative investors and more about those who want predictability with the trade-off. The buyers are trying to beat the market. They're outsourcing timing to the product itself. Is that kind of what we just talked about?
We're diversifying timing risk. Yeah, exactly. Okay. Yeah, we keep reading here if you want, but
the high net worth investors who want the smoother coupons in sideways markets, advisors managing clients who fear the drawdowns. That part I think we know is part of the sales pitch, and yield seekers in low vol regimes. That kind of comes back to what you mentioned earlier. Is it it's different than a bond proxy, but like it kind of can be thought about that way.
Yeah, you're going to get that high stable income level. There are risks. The risk you're taking on is a severe sustained market drawdown like 2008 as we described. But people who are seeking income, they're using this inside their portfolios. The volatility is going to look a lot like the S&P 500 over time. So you have to be comfortable with equity-like market volatility, and you can exchange that for a really high, stable coupon. So, the last piece that we didn't mention is taxes. The coupons are remarkably tax efficient. About 90 to 95% is going to be treated as return of capital. So that's just going to reduce your cost basis. You'll pay long-term capital gains if you've held for longer than a year.
Okay. As the fund gets bigger and bigger, are you going to be able to find all the auto callables you need?
We don't have to find any. So this is all synthetic. It's swap-based.
So we can. You can just keep building it out.
Exactly. Yeah, we can scale this into billions of dollars with no issue.
Got it. Yeah. Okay. Fascinating stuff. A big success story for a big fund, $250 million plus, right? As you said,
still
now
going.
Florida 280. CAIE is the ticker.
That's it.
You guys have a lot of other funds too, so let's be in touch and definitely want to be in the loop as well. Appreciate it, Matt. Thanks for your time.
Thank you.
Good stuff. Matt Kaufman, head of ETFs at Calamos Investments here in Chicago. All right, the real OGs, the fans of the show, will know by the end which buildings are which. So you're going to learn along the way. It's an architectural lesson too. We got Mr. Jimmy Lee joining. Maybe we go straight to Jimmy since we're having discussions here about what advisors want and what's hot in the ETF market. Jimmy's joining us, a wealth consulting group, a sponsor on the show, but 15 episodes. So we're glad we finally got you here, Jimmy.
Great to see you, Ollie.
Likewise, I should also introduce you as the biggest advisor in Vegas as well. We were hanging out in Vegas a couple weeks back for the Hood Summit. Then I went to Munich, Germany, and then you went to California. It's been like the season of conferences.
It really has been. I was at Future Proof. It was a great conference. I think that they've disrupted the conference industry for financial advisors.
Yeah.
On the beach is hard to beat. A lot of great content, not the typical content that you hear at advisor conferences. So it was a good experience.
Yeah. One of the things, my big takeaway between Robinhood Summit in Vegas and then the institutional-minded RMC in Munich was that both those categories of traders were all glued into options. But then I also feel, Jimmy, that a lot of the stuff I'm seeing in the advisor world increasingly is about options too. Case in point, the auto-callable funds, swaps, derivatives of different forms, and ETFs trying to make their way into the advisor world.
It really is. You've seen a lot of it in the ETF structure now, as you were just talking about, but also we've been using them inside of structured notes. And so I see that trend continuing to get even bigger. And I think more and more advisors are looking to put in some downside protection. The ETF is an interesting way to do that, so that it's a very easy kind of a non-complex product, so to speak, for advisors to use in any sort of a retail account. So I see those types of option strategies inside of ETFs continuing to get market share. And I also think structured notes are going to continue to do what they've always done with option strategies inside of them, and a lot, maybe even new strategies that the traders will come up with.
Jimmy, is there an irony? What is your take on what I've described as kind of the irony that all these funds designed to protect from the downside are becoming hugely popular in a market that has so few moments of downside?
Well, at least hedging strategies usually, Oliver, come out after the bear market, and then it's usually the worst timing to use hedging strategies, right? And so at least this time around, advisors are interested, and their flow is going in when some people would think that the market's expensive. Now, we've been bullish all year long, and we have not been in the recession camp for the last several years. So we've had a nice run at our firm since 22, which was also an interesting year, right? Where the stock and bond markets were both down in tandem the most, I think, since the Great Depression in the combo strategy. And so I think since then, advisors, have been a little bit remiss about the volatility because we haven't had a whole lot of it until this year. But that V-shaped recovery, as we know, has come back, incredibly strong. And we believe that there's a chance that the S&P 500 could get to 7,000 even before year end.
I mean, NVIDIA's breaking out today. Tesla's breaking out again. Semiconductors, it's hard to really figure out the bear case, Jimmy, until something comes, very apparent, whether, it's in a market structure somewhere, but it's a very hard thing to know. It doesn't seem like there's a lot of big, obvious risks in my mind. Maybe that's why people, though, start to think about protecting downside because they've had so much upside, right? Preserving their capital.
Yeah, and I'm so happy that you're doing your show there at the CBOE. I mean, I don't think a lot of people have an eye into the floor there, like we're seeing now, and it's like the good old days at the New York Stock Exchange, right? And so I think it's a great job that you're doing there, and
Thanks,
great
Jimmy.
great exposure there for the board there. So anyway. I think that there are some other trends evolving in the advisor industry.
What did you take from Future Proof? What stood out? Was it some of these themes from the ETF world of like options-driven stuff, or what else was hot?
Well, certainly a lot of different, ideas, new ideas when it comes to product and investment strategies. But one of the trends that, one of the things that I think is going to get even hotter is this whole M&A activity. We've seen a lot of M&A activity in the financial advisor space over the last decade. Yeah. I think it's just getting started. I mean,
advisors buying other advisors, private equity funding advisor buyouts, right?
That's right. And aggregators, new aggregators. I mean, think about that headline we saw last week about the $129 billion Merrill team, that works with the corporate executives. Now, when you look into those numbers, I read that maybe less than 30 billion is private wealth and the rest is corporate stock. But still, that's a gigantic team. It's unprecedented, I think, in terms of numbers. I think you're going to see more and more of that happening. And a lot of those firms will become the new aggregators that will compete with the ones that are out there today. And so I think there's a lot of choice. And just because of the demographic of the advisor being around my age or older, a lot of people are thinking about monetization. They're thinking about succession for their businesses. For most financial managers, the business is the most valuable asset in their net worth. And so it's really important that we as planners plan for ourselves and our businesses so that not only are our families protected, but also our clients.
Yeah. Well, I mean, that's kind of the story of what you did in Vegas, getting bigger, growing to be the biggest RIA in Vegas. When you kind of think about, when you start getting close to like a $10 billion, Jimmy, I think, we've had advisors on the show from some of the big ones here in Chicago, representation from these massive roll-ups that are nearing hundreds of billions. But obviously most advisors are in the camp where they're, quite a bit smaller and they're trying to stand out or they're trying to pass on their business. What do you think helps them stand out right now? What do you think are those characteristics that are going to make an advisor appealing over one when there's so much money looking to find a home?
Well, I can tell you that from my experience, for decades, ever since I got into business, I don't want to date myself, but I've been chasing the same thing really, which is to be more of a comprehensive advisor to our clients. So touching, the tax planning part of their financial planning, the trust planning, and other things that involve money. And for the most part, I think advisors have just paid a lot of lip service to it. Now, I think there are a lot of great advisors that do regular financial planning, but because of tech and because of investments into our space, we're seeing, venture-backed companies like Wealth.com, which is the one we use, or Trusted Will, or Vanilla, kind of disrupting the estate planning world. And then you're seeing the same thing in the tech side. And so I think financial advisors really have an opportunity to up their game in terms of what we do for our clients to provide more services so that we're not just reliant on the portfolio management service that we provide, which in many cases ends up being a commodity.
Nice. Interesting. I see. Jimmy, one of the big things that I took away from Robinhood Summit in particular, because they did a big deal with Trade PMR to kind of bring the traders into the advisor world. I wonder if there's a connection and kind of how you think about that, maybe from more of a client interface standpoint, where there's a lot of people who have made big gains in the market trading. They're active traders. Is that a potential market for, advisor kind of trends as well? Because it seemed like the message from the Hood Summit was, hey, you made all this money trading. Now you need to preserve it,
Yeah, I think it does. Not necessarily that advisors want to become traders, but I think in terms of trading strategies, using option strategies or other types of strategies to hedge risk, whether it's single stock, which there's products out there to do that nowadays, or other ways to hedge, the risk in positions that you've made a lot of money on, or to mitigate taxes. We're seeing a plethora now of tax mitigation strategies that are coming out there, that are out there now, actually, and some that were born out of Chicago, wherever you're at.
Totally.
And I think those are innovative things that weren't around before, right? So the evolution of direct indexing, kind of supercharging the idea of maybe accelerating tax losses for clients and maybe offset capital gains that they may have in their portfolios. These are all things that
big theme right now. I've seen that.
We're talking about it right now. And I think in the RIA space, we're privileged because a lot of these strategies come to us first. It takes them forever to try to get into a wirehouse or to a large firm or a bank, or, so they come to the family offices and the RIA space first. And so we get first look. And I think in a few years, there'll be a lot more action across the industry. But some of these most innovative strategies come to the RIAs first, which we're very privileged to have that access.
Jimmy, finally, while I got you, I got to ask, I've seen some headlines on Vegas, prices dropping. Is it buy the dip or what's going on? Is there any fringe of dwindling risk appetite out there?
Great timing on the question. I actually posted something on LinkedIn about the subject because I was recently with some friends of mine on the East Coast, and they're asking me about the headlines they read about Las Vegas with revenues being down. And quite frankly, for me, I wouldn't bet against Las Vegas, just like I wouldn't bet against places like Chicago or New York. They're always going to bounce back, and even stronger in most cases. And in this case, in my opinion, it's basically coming from the tensions from geopolitics and tariffs. My friends in Canada skipped their trips to Vegas this year, which we rely on Canadians to come to Las Vegas in the summers, especially. They didn't come, and or all year long. And also from Europe. And so I think it coincides with the the trade tensions that we have. And so once that blows over, I think we're going to be right back to normal. Of course, prices have gone up, but I would say that, Las Vegas is more of a mecca for people that want to live there or go there for entertainment than it ever has before. Think about all the professional sports we have. It started with NHL. And my friend reminded me.
The ASU game we went, or the Las Vegas game we went to was packed.
Yeah, it was packed, and then you got the Raiders there for the NFL. We're gonna get the Major League Baseball, and then most likely an NBA franchise. We have the WNBA. My friend reminded me to mention that, and we've been talking about MLS for a long time. And the amount of wealth, F1, the amount of wealth that's come to Las Vegas is stunning. It really is stunning, and it's a very good place to be an entrepreneur. So it's a very business friendly and tax friendly environment.
You're making me jealous. I gotta go, Jimmy. I want to be. You know me. I'm always ready to be in Vegas. Actually, next stop is in December, I think, for Scott Bauer's Prosper Trading Conference. So might be seeing you then. Appreciate you, Jimmy. Good to catch up, sir.
Good to see you.
Thank you, Jimmy Lee, Wealth Consulting Group. Risk Radar coming up next. Be right back. Stock's looking pretty good here. S&P 500 making all-time highs. Scott Bauer joining us, CEO Prosper Trading Academy. Scott, good to have you here. Episode 15 on Chicago Future of Finance is an all-time high in the S&P.
I mean, here we are. Yesterday we talked about, what would potentially happen with a shutdown, that it's typically not that big of a deal. But I would say the reaction we got today, being from the little bit of a sell-off we had overnight and then on the opening to where we are now, again, Oliver, we've talked about this market is just Teflon and it's grinding higher. And, I don't know what's going to get in the way. I mean, yesterday we talked a little bit about maybe something geopolitical or something, but obviously right now the shutdown is no big deal, at least for the market. But, there definitely has to be some concern out there if this thing is protracted. If this thing lasts more than a couple of weeks, you will absolutely see it filtering into the economy and see some, data points probably get really hit from that.
We saw Kalshi earlier. It was, I think, a 31% chance of more than I don't know what was it, 35 days or something like that.
Yeah, I think it was a month or something. Yep.
Yeah, sorry, more than 15, 2 weeks. More than 15 days at 34%. I mean, that seems like a pretty real possibility, a third.
There's no question, and we talked about this as well, that this particular shutdown is different than the other ones that we have seen because of the great political divide that there is. That truly, it seems like neither side could care less about the other side, and it's really kind of disparaging, regardless of which side of the aisle you're on. It really is. It's not good for America.
Yeah.
And so that, I think, is why we're seeing such high probabilities of this thing extending on.
But for less than just a couple days, now part of like our just routine. So I guess that's where kind of if you start to try and make a trade on it, then it's got to be at least 10 days, basically a week or something. Like, I know it's kind of hard to gauge, but that's kind of the point. Basically, is a few days is now like part of
it really is. It really is, and the way that option premium is going right now, implied volatility, it is pretty cheap. It is really cheap across the board. So if you're looking for something to play a week or a couple weeks, maybe a month down the road, you can buy that particular position, whether it's a downside put spread, upside call spread, if you think things are going to, be okay. And you can get in pretty cheap right now. And what that also says is, with the VIX sitting at 16 right now, which it is, that's a 1% move in the S&Ps daily. That's pretty much, about what we're seeing. A little less than that today, but we saw S&Ps down, 30 plus overnight. Now they, went up 30, so that's almost 1%. But volatility is cheap. So, if you're a bull in the market and worried about a little hiccup, worried about a little pullback, buy some cheap protection.
I'm bull in the market, Scott. I'm gonna pull up the risk radar. I've had the green on for stocks since the show started, and green for gold too. I've had Bitcoin yellow alongside the dollar and bonds. Nothing red. The yellow stuff, it looks like Bitcoin's trying to heat up a little bit. Maybe that one would be the next to go green here.
I mean, it's all bets are off at this point. Honestly, I'm not sure there's anybody that I know that I have met in my 35 years of doing this that could read the tea leaves right now and read any charts you want and say with any sort of certainty what the next move is going to be. The only thing I can look at and say, hey, the trend is still higher. That is. So on pullbacks, if you buy, you're doing well. At some point, that trend is going to break. But I think all bets are off for what might happen.
Yeah. It seems like if tech's breaking out the way it is, stocks are breaking out, you kind of just assume that the risk spectrum will follow. But that being said, economic data with employment Friday, Scott, give me a quick thought on what to look for, either dollar bonds or stocks. Do you think these numbers can shake anything up?
Well, I'll be honest, because I've been a little sidetracked today. Are we still getting the numbers on Friday morning, or did they say we're not going to get it?
I guess it depends when the government is functioning.
Exactly. So we may not get that number. And if we don't get that number, I think that just adds volatility to the marketplace, especially after what we saw from ADP this morning, being a negative revision. I mean, that is pretty
Everybody's now going to think that it's a bad number, right? People are going to think that this is a way to...
Everybody is going to be expecting a bad number. There's no, whenever that might be. But if we don't get it Friday, it extends into next week or whenever it might be. That's got to be some pent-up energy in the market. That's got to be some pent-up volatility here with the expectation of an outsized move.
All right. So far, the move is higher. Record 67, 11, 20 at the close for the S&P 500.
Pretty unreal to really think about it, that we're literally almost 6 months to the day from Liberation Day, from where we were back then to where we are now.
I held up tariffs, the sign.
Yeah, nobody could have thought what was going on right now.
Yeah. All right, all-time high. Scott, thanks for being here for it. Appreciate your contribution here over these 15 episodes. Coach Bauer and the Risk Radar, green for stocks, a green for gold. We'll see if Bitcoin joins in after a nice run. In this session, MicroStrategy had another 5% bounce. S&P at all-time highs. Semiconductors ripping. 15 episodes in of Chicago Future of Finance. Thanks for joining me. Tomorrow, I'll be filming from SIBO's Quant Conference. Should be pretty fun. Have a great night.